JPMorgan Citi, Wells Fargo, and Bank of America kicking off earnings season this morning. JPMorgan coming out on top, at least for now, raking in a record $49 billion in net income. The stock gaining just around 2% here at the open, have been up nearly 2.5%. That was the largest gain that we've seen in nearly a month. So here with more on what these early results tell us about the rest of the earnings season and some of the movements that we could see in the broader market, we want to bring in Ben Emons. He is NewEdge Wealth Senior Portfolio Manager. Ben, it's great to have you back here in studio. So let's talk about these results. Your takeaway from some of the strength that we saw from these banks and what that tells us then in terms of setting the tone for earnings season.
Yeah, I think the FDIC charge was a bit of the, let's say, the headline dampener. But if you look into JPMorgan being such an incredible machine, particularly wealth management business now reaching like 3.4 trillion in assets, and the other banks like Morgan Stanley and Goldman are obviously big in that area too. So I think that sets us up for earnings season for those, as in they're trying to gain market share there. Probably good results there potentially on that front. Whereas with Bank of America and Wells Fargo this morning, there was some increase in charge-offs on loans that are getting a bit sour here. So that's, I think, why those stocks were down and taking obviously that hit from the FDIC. It does come to roost ultimately, right? The regional banking crisis may have subsided, but the big banks have to pay for it. So I think also Morgan Stanley probably has some of that and Goldman next week. So I think it's a mix to good picture, but it's not really the driver today though for the market. It's really energy that's really about.
Does those loans running sour signal to you that the resiliency in household balance sheets, in some of the small business balance sheets might be coming to a close?
It could be, but I think it's still early days because it's amazing how the call it the Fed rate shock is not yet caught up with the economy in such a significant way. You know, a different area of this, just to briefly highlight, is private credit, where there's a lot of money going into private credit, and interest there is very high, and it hits really the economy on the ground, right? As in, you have small companies that use private credit lenders, and there's no distress seen there. So I wonder if we're living with high rates and we're able to live with high rates, that's really continues to be the environment that we're in, that these charge-offs are just small impairments as opposed to a broadening distress cycle.
But I want to go back to what you just said a moment ago, and that was just in terms of the fact that energy really the driver of the markets, at least for today. When you see the spike in oil, the threat of escalating tensions in the Mideast, how are you evaluating that as a portfolio manager, as a strategist here in terms of some of the uncertainty or volatility that we're likely to see in the coming weeks?
Well, this coordinated attack is definitely an escalation. Before it was all just a lot of noise out of that region. And the Houthis have always been in that area active and doing something on a very local scale. So getting now a coordinated attack by countries is I think an elevated moment here. Now Iran will still be very carefully trying to test the waters. Lots of discussion about whether they could actually disrupt shipping in the Strait of Hormuz, right, which would be I think the big event for energy markets. But Iran is also going to shoot itself in the foot if it does, because there's about a million barrels of Iranian oil going through that strait. So what as a portfolio manager I take from it is, one, yes, there will be some pressure on energy prices here because there's some risk premium built in there. Because really you're seeing oil tankers taking a detour from these canals, and that will lengthen the time of delivering oil, and that was repriced. Same thing with those other shipping companies. So it will show up a little bit in the supply chain again, but it will not show up in our inflation numbers. Because if you look at PPI this morning, that's all soft still. That's all still past supply normalization. They will take actually maybe a few months before we actually see the true macro effects from the current events. And it's interesting too that the markets are not taking this as a flight to safety moment. The only two sectors are up are gold and energy. And I think gold is maybe because of people thinking of the Strait of Hormuz and using it as, okay, that could be a tail risk. Energy, obviously, because people are trying to discount what does this really mean for supply against the backdrop of a China that continues to have record import of energy, but being a really sluggish economy if you've seen the deflationary numbers overnight.
What is the best trade for someone who is trying to perhaps mitigate their portfolio from some of these exogenous risks then?
Yeah, will be the year, I think, of diversifying in defense. You know, and it could be different things, though. It's not necessarily always healthcare and utilities that people choose, sure. Even though they're, you know, maybe in some ways valuation-wise interesting versus tech. Really, I mean, tech actually could be a really good defense play here, and so far showing that tech is actually not relenting in any way. But I think the other environment is really about how gold will, I think, behave, and Bitcoin now too, because I think people do look at tangibles in an environment like that. You know, gold being, it is actually getting stimulus from flight to safety, but also gets stimulus from future easing of the Fed. And then you have obviously now the events around Bitcoin being more institutionalized in an ETF product. You know, people look at this as a diversification against however this energy shock will play out, if it happens. You know, what that then will mean for conventional assets like stocks and bonds. I think, yeah, playing defense in Bitcoin and gold is an interesting play.
All right, Ben, thanks so much for taking the time here. As always, great to see you in studio, even on a Friday. Makes his way into the office here. Ben Emons, NewEdge Wealth Senior Portfolio Manager. Thanks so much for taking the time.